Good afternoon. Welcome. I'm Llewellyn Cox from Lab Launch, and this is Startup Conversations. Uh, Lab Launch provides quality, affordable lab space for startups and small companies, primarily in the Los Angeles area. And we're really excited today to be joined by Alice Cheng from Upfront Ventures.
Hey, thanks for having me.
Great to be here. So just to kind of kick off, Alice, just if you could tell us a little bit about what you do and what Upfront Ventures does.
Sure. I'm an associate on the investment team at Upfront Ventures. Upfront Ventures is an early stage generalist firm based in Los Angeles. So our office is in sunny Santa Monica, which you'll see right behind me. And we are currently investing out of our sixth fund, which is $400 million. We've been around since the 90s, so for a long time, and we invest across industries. So if you go to our website, you'll see companies uh, in D2C, in enterprise, also now in deep tech. And so this is, when I say deep tech, we're starting to move more into healthcare, robotics, digital health, things like that. And we're really excited about all of the innovation going on in LA and Southern California.
Cool, thank you. So one of the reasons that we wanted to put together Startup Conversations was to demystify the processes of starting up a company and help people in maybe the sciences understand more about the business side of startups. So one of the questions that I get asked the most is, what is all this with funding rounds? What is this alphabet soup of series A's and B's and seeds and other assorted vegetables? What does that mean to the average startup?
Yeah, that's a great question. So I said earlier that we were early stage, and that's a pretty broad term if you are maybe just starting out and trying to understand what does that mean. The other day, I actually just had a conversation with somebody who was raising an early stage fund, and I said, well, our average check size is 3.5 million. And he was like, well, I was looking for early stage. You said early stage. I'm only raising $400,000. So where do I look for that? What is that called? So when we typically think of stages of funding, and it's kind of shifted over time, so there isn't really a solid definition for what's like a series seed or A in terms of dollar amount. But typically, when you start a company, there's initially you might have something called like a friends and family round where you're just raising a small amount of cash, maybe 50,000, a couple $100,000, just to like maybe get a lab space if you're doing that, or write some code if you're doing something on the digital side. And then after that, you would look for something called a seed round. And seed also has many forms. There's like pre-seed, which is kind of depending on the capital, maybe less than $1 million or $1 million, and then seed, which is like maybe 1 million to a couple million, and then your series A, B, C, D, what have you. So it's not necessarily like, oh, you're raising 2 to 5 million. That's a seed round, but more like, is this your first round of funding? And how much progress do you need to make before your next round of funding? Typically, on the biotech or life sciences side, we see companies will usually have some sort of grant money, and that kind of compensates for what we typically see as like a friends and family round on the tech side. And then they would go out and sometimes raise a seed. Sometimes you might just see them raise like a huge A, like 20 to 50 million or even more. So it all really fluctuates depending on your industry. So I know it can be confusing, but generally it is like seed, A, B, and then so on.
Cool. And so a lot of people coming into this, at the beginning of this cycle, they're thinking about, okay, so what do I need in terms of progress for each of these given rounds of funding? So um, obviously there's as many different answers to that as there are questions, but kind of from a big picture view, what should companies be thinking about on day one as they start to plan out their journey through the funding landscape?
Sure. So at the earliest stages, what we typically look for is a great team and great science. So, when you're building something that's based on probably years or decades of research, we kind of assume that the science is solid, right? Typically, it comes out of research lab. You've already published papers, and what we want to vet there is that it's reproducible, that the results are can lead to something hopefully in the clinic. And that's always hard to tell because sometimes you're working, at the very small, at the cell level, and you obviously have to translate to humans, and that could be a few years down the road. But something that, could potentially be very beneficial down the road. That's kind of what we think about. And then the second aspect is team. And so this is really important because you don't necessarily have all the technical pieces and data and proof points in place. So we want to know that you have the right team that can think about what experiments you want to do next. So both on the scientific side, but also on the business side. So when we talk about fundraising, it is going to be a lot of meetings, probably cold calling, probably making decks and negotiating and things like that. And, you don't necessarily have to have a CEO. A lot of founders will, be on the founding team. They can do that. But it is also good to have maybe a mentor or somebody that can help you through that process, because there will be a lot of face-to-face, well, now virtual, but a lot of meetings where you're trying to fundraise and get through that process. And there's kind of like soft skills involved there that aren't necessarily just based on how much technical knowledge you have.
Cool, interesting. And I think something related to kind of planning out this journey as well is, there's just like with funding rounds, there's a total alphabet soup of funding instruments. So two of the most common we come across are convertible notes and safe notes. And there's obviously other forms of equity, but if you could kind of very briefly explain, what these are and how they relate to the startup and the investor, that would be really helpful, I think.
Yeah, sure. So, we talked about earlier, like seed round and so on, A, B, and so on. Convertible notes and safe notes are typically before seed, or they're just like basically like the first instruments for funding before you have like a priced round, is what we call them. So, convertible notes and safes are very similar. The one big difference is that convertible notes are debt and safe notes are technically not debt. So basically, these things are a guarantee for you to be able to get equity in the next round. So, for example, I want to put in $100,000 into your company, but you don't have any. You haven't taken any investor capital, and there's no, I guess there hasn't been an official price round yet. So I don't know what ownership I'm going to get. I just want to give you the money, and we'll figure out ownership later on when there's another investor and we can kind of figure out all the cap table stuff, which we can talk about a little later. I could give you $100,000 in the form of a convertible note or a safe. In the convertible note, if you, let's say in 2 years, don't end up raising a round, I would get my $100 back with typically some interest, like a 5% interest or something like that, just for the time that I gave you, that you had my money. In the safe, and safe stands for simple agreement for future equity. It was an instrument that was invented by Y Combinator. It takes away that debt piece. So basically, if you don't raise a round, you don't raise a round. But if you do raise a round, it converts into that round, just the same as a convertible note. And both these instruments both also have, typically, not always, but will have a discount or a valuation cap into the next round. And that's basically an incentive for me as the investor. If I wanted to give you 100,000, but I'm giving it to you now before anybody else is supporting you, when it converts into the next round, I'd like to get a discount because I invested in you early. So that could be 10%, 20%, whatever it is. A different way to do that is a valuation cap. So it's saying I'm technically going to value your company at 10 million, 50 million, whatever that is. And if the valuation happens to be higher, the difference then is the discount that I'm getting into your round.
Cool, really interesting, and thank you for explaining such a really complex area so quickly. And something you mentioned related to that, and I think this speaks to another big challenge that startups have when just putting together their first ideas about how they're going to finance the company, is this concept of a cap table. And of course, that's related in early rounds to the valuation, or at least that nominal valuation you mentioned when putting together a cap or a safe note. So if you could help us understand what is a cap table, and how does it affect valuation, and how should you think about valuation as an early stage founder?
Sure. Well, I'll start off with the cap table, which should hopefully be more straightforward. A cap table or capitalization table is really just a table showing the ownership of different people in the company. So, if you're the founder and you started the company, you own 100% of it. Maybe you have a co-founder, or you bring on a CEO, or you have a professor or whatever, and you decide to split the company, and you get 51% just so you have majority voting rights, and then you give your partner 49%. Then the cap table has you and your partner on it, and it has you at 51% and your partner at 49%. Now, if you wanted to bring more people on the cap table, let's say you have an investor, then that investor would take a certain percentage of your company, and that would also be reflected in the cap table. So maybe the investor, let's say, takes 20%. That means you and your founder are both, we call diluted 20%. So your percentage goes down by 20%, your founder's percentage goes down by 20%, and that 20% that's remaining, the open 20% goes to the investor. And this changes based on the investor, and this ties to valuation. So when we talk about valuation and fundraising, the simplest way of calculating dilution on a cap table is the amount of money you're raising divided by the post-money valuation. So let's say you're raising $1 million and the post-money valuation is $10 million. The dilution is 1 divided by 10, or 10%, meaning basically if investor one invests 1 million in your company, they get 10% of your company. Everyone else gets diluted by 10%. So that's a really simple way to calculate that. You'll get into more complex forms of cap tables once you think about option pools. So, when you join a company, you typically get options in the company. So to incentivize people, if you can't pay them a lot, you give them more options, and that's ownership in the company. That gets reflected in the cap table. And then things later down the road, so additional financings will continue to dilute you. So I know nobody loves being diluted, but that is the price of capital. But it does vary based on the valuation, and that's why valuation is important.
Thank you. It's really briefly concerned. Again, a hugely complex area that everyone gets tripped up on. And I guess the most important thing is to make sure that you don't sell too much of your company for too little, too early.
Exactly.
And so we have time for kind of one more question, and something that you mentioned earlier in terms of how you evaluate teams, actually, I think is really very important for founders. And obviously, you mentioned you're looking for scientific expertise and you're looking for, a business vision. So obviously, a lot of, entrepreneurs we meet are coming straight out of the lab. They're very talented scientists, they're very smart people, and they probably understand the very 10,000-foot view of business. So if they want to start a company, where should they look for that team that they can build to fill in the gaps and really build that team that you're looking for as an investable company?
Well, I think, we talked a little bit about mentors and angels and, friends and family. One thing that we look for in a team and, in a founder is also their ability to build a network and inspire people and build that vision and show people that vision. So it really, when early on, whether they invest or not, you can get people really excited about your technology. Hey, this is what I'm doing. Go to dinners, talk about it, go to your family, talk about it. And eventually, if you say, hey, I'm really trying to build this thing, I have a couple questions about convertible notes and this first round of financing. I'm not really sure about the transactional details. Do you know anybody who can help me? And there's so many mentors, especially in Southern California, especially in Los Angeles. We all want to help each other in this ecosystem, that there'll be people who are willing to talk to you. I mean, I would be willing to talk to you. There would be people willing to talk to you about kind of like what these next steps are, what those things mean. And, as you go through that, you get people excited about your technology, and you also build the mentors and advisors for your company. And again, they don't necessarily have to be on your team full time. They could just be, advising, and you don't have to pay them. Some people will give them a small portion of equity if it makes sense. And then when you do raise that round, typically you'll have the investor take a board seat. The lead investor takes a board seat, and that board member is basically your go-to mentor advisor, and they should help you. And when you get to that point and you're like, okay, well, I've raised my first round of funding, I do have a board member now, or I'm there, and the angel investor is going to help me, I need to hire like a CEO, or like I need to hire a chief business officer, whatever that is. Lean on your board, lean on your investors, because they also want you to succeed. And if they have any money invested, they definitely want that to grow. So don't be afraid to ask. And, like I said earlier, I think this ecosystem locally, geographically, we're all willing to help each other. And so if, don't be afraid to just reach out and ask people. It's one of the things, it'll make you a great networker. It'll make you a great business person down the road, even if you choose not to take that CEO seat.
Fantastic. That's really great advice. Thank you so much for your time today. This has been a really enlightening conversation, and we really appreciate your thoughts and your time. So real briefly, how would people get in touch or find out more about Upfront Ventures if they're interested in approaching you for funding at some point?
Yeah, absolutely. So we are upfront.com, and you can find us on, you can just go to the website, but we're also on Instagram, Twitter. We are now on Clubhouse, and you can find me at alice@upfront.com.
Fantastic. Thank you so much for your time. Thank you for joining us today. And to everyone watching, if you want to get in touch with us at Lab Launch, you can email us at team@lablaunch.org. Check out our website at lablaunch.org. Or as Alice said, we're on all the socials at Lab Launch. So thank you for joining us. We hope you enjoyed our program today, and we hope to see you again soon.